Hi, my name is Bob Miller over at Mutual Omaha Reverse Mortgage, and I made these videos to dispel some of the common myths about reverse mortgages. There's 8 major ones, and in this video, we're going to cover the first 4. But first, a little disclaimer, I am not an attorney, I'm not a financial planner, and I am not a CPA. What I am is a guy who does reverse mortgages all the time, and I love talking about them. So let's jump right in. Myth number 1. The lender owns your home if you have a reverse mortgage. The fact and the truth is on this one that the lender is not on title. It's important to remember that there's no difference between a forward and reverse mortgage in that the lien holder, or the bank, has a lien on the property. It has nothing to do with the title themselves. The owners themselves always have the power to sell the property or refinance it at any time. It's their property. Now, of course, just like a typical forward traditional loan, you have to abide by the terms and conditions of that loan, but that's another subject. Myth number 2, the funds received from reverse mortgage are taxed. The fact and the truth is on this one that the reverse mortgages proceeds are received tax-free. Now, what you do with that money might put you into a taxable situation, but the actual proceeds themselves are received tax-free. Myth number 3, reverse mortgage are risky and the funds are not guaranteed if something happens to the lender. Now, another truth fact is that reverse mortgages have changed a great deal since 1960. The HECM, which is an acronym for Home Equity Conversion Mortgage, have been in place since 1988, and they are regulated by Housing and Urban Development, and they're FHA insured. Now, keep in mind that a HECM is not a proprietary lender product, so they're not dependent upon the liquidity of any one particular lender. These loans are sold in the secondary market just as they are with traditional forward-based lenders. Now, of course, borrowers have to occupy the home. They have to, as a primary residence, they have to stay current on taxes, homeowner insurance, and the HOA fees, just like they do on a forward loan. But again, these are sold in the secondary market, and they are not dependent upon the liquidity of any particular lender. Myth number 4. The borrower can end up owing more money on the house than what it is even worth. Now, the truth and the facts on this one is one of the coolest aspects of reverse mortgages. This is a non-recourse loan, meaning that the lender's sole recourse is the property itself. They cannot go after the borrower for any deficiency. They cannot go after any of the heirs for any deficiency. It is only the property itself that secures the loan. If in fact it does become upside down in the future, first off, they cannot make the borrower move out of the house simply because the property is upside down. What the lender would then do once the loan comes to an end, meaning that the borrower dies or moves out of the house or sells the property, is that the FHA will then cover the lender on any deficiency that exists. Very cool thing because, again, this is no deficiency going back to the borrower, going back to the heirs. Their only recourse is the property itself. Well, hopefully this video helped dispel a few misconceptions surrounding reverse mortgages. For your individual situation, if you have any questions, comments, or you'd like me to run a scenario based upon your personal situation, feel free to give me a call, reach out by phone or email. I'd be happy to run it for you. See if it works for you.